financing your future with a look at a new year, new you. These are uncertain times, tensions at home and across the globe, 401ks and investment portfolios under pressure. How do you save in this volatile market? Real estate cooling, interest rates rising. How do you protect your money from inflation? The opportunities, the possibilities. Is cash king again? Reach your financial goals in the new year with money resolutions you can keep. Join us now for this Yahoo Finance special, New Year, New You.
Welcome to Yahoo Finance's New Year, New You. I'm Akiko Fujita along with Rochelle Akufo. Happy New Year to all of you. Over the next hour, we're going to be breaking down the big issues that could affect your investments in the coming year and what you can do to safeguard your cash. Has inflation peaked? Are we already in a recession? Our team of experts will look to answer those questions and guide you through an uncertain 12 months. The show is brought to you by Synchrony Bank Savings.
So as we mentioned, there are lots ahead. We're going to speak with a host of key voices to really guide your personal finance journey. Catherine George from Wealthstream Advisors will tell us what we can do with any cash reserves if the going gets tough. And Akiko, we've seen increasingly people dipping into their savings because of inflation and perhaps having to pay a bit more with their loans as interest rates continue to climb. About more than 60% of Americans are living paycheck to paycheck. So really every little bit counts. And Jamie Dimon predicts that the excess savings, about $1.5 trillion altogether that they have in the US, will they'll actually have run through it by this year. So how do you prioritize it? Do you pay off your debt? Do you build up your savings reserves? Do you plan for those sort of financial emergencies? It's a lot that people have to try and manage with a lot less money than they're used to.
Yeah, and we're going to be trying to answer some of those questions over the next hour. As you pointed out, there is the inflation question, but also a lot of retail investors sort of counting their losses after the year we saw last year. The S&P 500 down roughly 20%. The question now is going to be, well, where do you put that money if the market isn't necessarily working for you? And as you point out, it's not just about investments, but savings as well. And there is one more thing, Rochelle, I think a lot of people are going to have questions about, and that is crypto. We're going to be joined by Tyrone Ross, principal and founder at 401 Financial, to talk all things crypto. He says the Bitcoin blockchain is recession proof, but the token, not so much. That's going to be an interesting conversation.
I mean, it really will. I mean, sentiment, when you look at the fear and greed index, which actually tracks crypto sentiment, it's at about 26. And that's 26 out of 100. So there's a lot of fear around investing in this space. So especially if you're a retail investor, you've already been burned this year. You're seeing Bitcoin down more than 64% over the past year. So trying to sort of sort out the opportunities here, not easy. So it'll be good to get some expert insight as we separate the tokens from the blockchain opportunities as well, Akiko.
And of course, there are a number of other things that investors can do beyond just putting their money to work. There are ways to save. We're going to be talking about rates being higher, those credit card bills. If you haven't necessarily paid them off, this is the time to do it. And it's certainly very timely. Obviously, the start of a new year, new incentives in place, new goals in place. The question is going to be whether we can keep it on track. I'm not going to talk about my goals just yet, Rochelle, but it is a good time to really sort of reset the focus here going into 2023.
Absolutely. And before all that, of course, we're taking a look at the financial New Year's resolutions that a lot of people have been making, but as you can keep them as well, because 2/3 of Americans consider resolutions pertaining to their finances in the new year, and that's according to a survey from Ascent. We have Yahoo Finance contributor Vera Gibbons here with a breakdown. So Vera, a lot of people making these resolutions, what are they focusing on?
It's funny because according to Ascent, this is a record number of people making financial resolutions this year. And actually, it makes sense that we would be making them given the backdrop that you discussed. We've got potentially a recession coming. People are worried about layoffs. We've got interest rates rising, inflation continuing to rear its ugly head. So at the top of the list, you talked about this at the top of the show, is paying off that credit card debt. Now, at the beginning of the year, credit card rates were averaging about 16%. Now we're approaching 20%. So that credit card debt is becoming increasingly more expensive and will continue to become more expensive in 2023 as the Fed continues raising rates. Also a top priority any year, but particularly this year, is setting up an emergency fund. A lot of people don't have them. We are potentially headed for a recession. We don't know how bad this recession will be, but even if the unemployment rate rises to 5%, we're looking at 2 million additional people out of work. So it's good to have that emergency fund set up, not only in case you lose your job, but also for any other kind of unexpected expense that comes your way, whether you need it for a car repair, a leaky roof, etc. Revising your budget should also be at the top of the list in this inflationary environment. A lot of people haven't taken a more serious look at what's coming in the door, what's going out the door. Time to take a more serious look at that and make sure you're not spending more money than is coming in. Boosting your retirement accounts also is a huge one. You mentioned that it's been a tough year in 2022. Yes, it has. So a lot of people are discouraged based on the way the market acted in 2022. But don't give up. Keep on contributing to those retirement accounts. Keep on making those contributions as much as you possibly can, at least enough to capture the company match, because that is just free money. And last, I would say, really work on boosting your credit score. As the economy slows down in 2023, we are going to see lending tighten up a bit. So it's really important that if you want to continue to use your credit cards, that you have tip-top shape as far as your credit score goes, because we could potentially see credit card companies, the banks actually making some changes in 2023 as they tighten their standards, as the unemployment rate rises, because they don't want to get stuck with people who cannot pay. They're worried about defaults.
Vera, the third and fourth point you made, certainly going to be key here. When you think about the economic headwinds, reassessing, revising your budgets, what do you suggest in terms of how people keep track of it and stick to those goals?
Well, it's funny because a lot of people haven't taken a look at their budget. They've just been continuing to spend freely, which is why we're seeing the savings rate drop down to that 17-year low. They're spending as if they still have a lot of money coming in. They haven't taken a look at where they're at. They haven't factored in inflation. But so that is a key one for 2023. Now, in terms of keeping your resolutions in 2023, you've got to keep them what they call SMART. And that is an acronym for specific, measurable, attainable, relevant, and timely. In other words, you've got to make them realistic. You've got to chip away at the credit card debt. You've got to take a more serious look at what's coming in the door, what's going out the door. And you've really got to make it a priority in 2023, because I think it's going to be a bit of a bumpy year. We're coming off a rough year, 2023. We don't know what's ahead. Again, as I mentioned, inflation is still very hot. We're headed for more interest rate hikes. So it's going to be sort of touch and go in 2023.
SMART is a good acronym we'll all remember there. Vera Gibbons, as always, Yahoo Finance contributor. Appreciate the time today.
Thanks
so you made
much.
some monetary resolutions this year. That's a good step. The next step is keeping them. And Echo Huang, founder and president of Echo Wealth Management, joins us now to unlock all the ways to manage your money and invest. Let's pick up on that point, Echo, about what Vera said about managing inflation. That's got to be top of mind for a lot of Americans who are looking at their budgets right now. What are you advising your clients?
I think on the savings, definitely we need to focus on setting a realistic budget that requires us to do some work and plan ahead. Now is a perfect time actually to download the transactions from your credit card companies on bank and take a look at your actual expenses in the past year. You may need to make some adjustments and start a new budget and revise those numbers to really show the inflated prices. And my tips for that is create a budget that's really clear what the fixed expenses are and discretionary expenses are, so that you can focus on cutting out fat on the discretionary expenses that are, for example, like leisure, entertainment, and maybe cut out some subscriptions that you don't use frequently. And I think in terms of saving is not enough, right? So we also need to make sure that we need to invest the hard-earned money and grow your money during this very turbulent times. And so I think make sure, just as the previous speaker said, make sure you manage your debt wisely, paying down as soon as possible, especially high interest rate debt, and have rainy day fund to prepare for potential recession in the next year. So I think on money and saving, that's my advice is create a new budget and stick with it and review it very often. More importantly, for me to share today is definitely in terms of how you should invest your money during inflationary period. So I think for inflation, I do expect the elevated inflation to go down in the next 2 years. So that is the good news. But right now, at 7% inflation is still relatively high. So therefore, it's even more important to focus on planning ahead with an asset allocation plan. You need to plan for success. Right now, it's extremely important to really manage your emotion, because the recent performance has been very bad. As you see that, S&P 500 lost 18% and emerging market lost almost 20%. So even bond market last year lost 13%. So really caused people to think, should I be putting my money in the markets right now? And my answer is definitely, here's how you can get started. I think first, you should have asset allocation plan. Ask yourself 3 questions. One is, what are my investing objectives? And second is, when do I actually need the money? And the third one is, how much risk am I willing to take to earn that kind of return? I think if you work with a financial advisor, you can construct a portfolio that is fit for you.
So let's break some of this down, because obviously for some people who have just started perhaps reviewing their statements from last year so that they can set the stage for the budget, how should they prioritize? What should they start with first so that they know that they're in a good and stable position to start investing?
Yeah, I always tell people that as you look at your cash flow, it's really important to plan for the next 1 to 3 years of cash flow. The rainy day fund in general, I would say to have 3 to 6 months minimum enough cash in a savings account, maybe some online savings account that pays higher interest rate to pay for your living expenses in case you need to change your job. After that, and of course, the very high interest rate credit cards, definitely that needs to have a plan to pay it down. My general advice is also tell people to, at this time, postpone the major purchases like cars or homes. And I don't recommend people leasing cars in general, because the mentality would entice you to change your cars very frequently. That would also reduce your savings. So once you set aside enough money for rainy day fund, I tackle the really high interest rate with a plan and pay it off. Then don't miss the matching contribution at work. Make sure you put in something at least to catch that. And then every time you get a raise, and you should increase your retirement contribution. And also, I think you should increase your earned income by asking for a raise if you haven't received one because of high inflation.
So you sort of broken down how to trim some of your costs there. There's a question of how you grow your money. Certainly a lot of investors got burned in the market last year and are wondering, well, where do I put that aside? I mean, is something like a high yield savings account a better place to park your money right now, given the uncertainty in the market?
Actually, for the long-term money, that requires long-term strategies. So I do not actually recommend people to park most of their money in high yield savings account. That is a good strategy for the short-term expenses. As I said, anything you need to pay 1 to 3 years would be good in a high-yield savings account. But for the long-term goal that you don't have to touch the money for like 8 or decade, from now actually lower valuations and higher yields today offer the best potential long-term return since 2010. So if you look at this, nobody knows when the bottom of the market is, right? If we are in a recession, but I must stress that it's important to continue putting money in the market and of course have a solid diversification plan. So it's not just putting in all in stock market if you're not willing to take on the risk. And so your portfolio can be diversified, including some bonds, US large companies, small company, global stock, and also some real estate. One data I want to make sure I emphasize is if you look at the data for Wilshire 5000 since 1971, after the 9 months worst return, you look at all these periods, and then look at what happened a year after that, average return is actually 12% after the 9 months worst period in the stock market. And 3-year return after that, total is 41%. So if people are thinking about, I probably have at least 80% of a portfolio I don't really need to touch for a decade.
Mm-hmm. Right.
Think of this is the perfect time to put money in to have that additional boost or return. Yeah.
Yes, you raise a good point. It does definitely depend on the time horizon. Unfortunately, we will have to leave it there. I know you have a lot to say, and I know a lot of viewers will probably be having some questions for you as well. A big thank you, though, to Echo Wealth Management founder and president, Echo Huang. Thank you so much. All right, coming up, getting defensive. Economists lining up to call for a recession. So if it's time to go long on bonds, how do you get into the trade? We talk opportunities in fixed income and why the curve matters. That's next.
Welcome back to New Year, New You, brought to you by Synchrony Bank Savings. Well, let's take a look at bond market performance today, tomorrow, and even far into the past. We've got Yahoo Finance's Jared Blickery at the Wi-Fi Interactive to walk us through this one. Jared.
That's right. And let's start out with the bond market. As we've been talking about, this is the 13-week T-bill, so technically not a bond. This is a short end of the curve. This tracks what the Federal Reserve has been doing. And over the last year, we've had a surge of activity. Went from near zero, accelerated in the summer, and then started plateauing later in the year, but still going up. And very important to understand that. That has put considerable pressure on risk markets. Now, here's the S&P 500. 1 year ago, the market was making record highs. First time we ever made a record high on the first trading date of the year. And you can see we're still well within a bear market, trading at the lower end of the range here, down 20% over this time period. Now, was it a bad year for bonds? Yes, it was. In fact, it was a worse year for bonds going back about 100 years. You'd have to go back to World War I. After World War I, as that was wrapping up, we had a worse year. And also interesting is that we were coming out of a pandemic, the worst pandemic since the very recent one that we had. Also interesting to look at this chart because B of A has done a great job of going back all the way to the 1700s. South Sea Bubble, if you guys haven't heard of that, you should look it up. But the Civil War is in here, post-World War I. UK going off the gold standard, Marshall Plan, that's World War II. Suffice to say, these are game-changing moments for the market. Now, let me show you my next slide here. This is negative yielding debt. Why is this here? Maybe out of place? No, because I am seeing this as the final chapter on easy money. Negative yielding debt was an experiment that grew in the era of easy, cheap money. And look at that decline here. From the pandemic stimulus to right now, that is round trip to zero. Not saying it can't go up again, but I think this is probably in the history books as a failed experiment. Now, looking ahead, January actually has very positive seasonality, especially in the third year of the presidential cycle, which is where we are right now. You can see this is the Dow's second best month out of the year. S&P 500 and NASDAQ, that is their best month of the year, number one place there. And stocks go up. Dow usually goes up 4% in January, S&P 500 about the same amount, and the NASDAQ almost up 17%. And a really good track record over the years since 1950, 16 up, 2 down, 11 up, 2 down, only because of the time period that we're looking at here. So we could see some activity pick up in January. And there's an old saying, as January goes, so does the year. That's in play too. So January, a very important bellwether for the entire year. I want to close on this. This is a look back on the total days when the S&P 500 index moved 2% or more. And this goes back all the way to the 1960s, basically the beginning, almost so. And you can see we are in an era of elevated volatility. 2020, 2022 really impacted the markets because of that high volatility. And there's no reason to think that it's just going to disappear out of the blue this year. But we'll have to see. Akiko and Rochelle.
Indeed, but certainly that history really helping there, give people some perspective, perhaps if they do need to hold on, if they do have a longer time horizon. Jared Blickery, great stuff. All right, cashing out. As inflation continues to outstrip the value of cash, investors are taking a closer look at liquidity, comparing it to short-term investment instruments, various forms of debt, and of course considering just how much they should have on hand. Well, joining us now with more is Catherine George, Wellstream Advisors Senior Advisor. Good to see you, Catherine. So for a lot of people wondering, obviously, when you have changing interest rates, when you have inflation, your budget isn't going to be the same as it was. How do you calculate how much cash you need on hand?
So it's really personal circumstance, but I'd say a general rule of thumb is anywhere from 3 to 12 months of expenses, depending on your job security, or do you have positive cash flow every month, or any upcoming expenses like a car purchase or a down payment or a home renovation. So really narrowing down what your expenses are and then building up a cash reserve that would satisfy those amount of expenses for 3 to 12 months.
What should that ratio look like? We were asking our guest earlier about, how much you should put money towards investments, how much cash you should be setting aside, how much should be actually being held in a high yield savings so that you get some return on your money. How do you look at that breakdown?
So all of your cash should be earning something, right? So now that we're in a higher interest rate environment, online savings account are a really great alternative to your typical checking, brick and mortar savings account. Online savings account are offering 3.5% in some cases to just have your money sit there. That's free money. So I'd say all of your cash, except maybe your month to month needs, should be earning some of that cash. Now, anything above this target that you have set for yourself, and really being disciplined about this target. And once your cash starts to get above, let's say, 6 months of your expenses, then you should really be putting that into the market. It's January, so we always think about going back to the gym and getting fit. And it's not kind of a one-time fix-all solution. It really requires consistency. And it's the same thing with your investments, being consistent with the monthly or weekly investments in the portfolio. And I'd say that, once your cash reserve is established, this is the best time to get in. We think about the saying buy low, sell high. And sometimes it can feel really hard to do that because of where we are in the market, but that's what we're doing right now.
And Catherine, you mentioned discipline and consistency, and a lot of us didn't have any sort of formal training when it came to financial literacy. It was money habits we pick up, and that really does determine how much risk we want to take on, how comfortable we feel taking risk, if we have any sort of cushion. So when people say come into a chunk of money, say a bonus or some sort of raise or something, but you still have the same old mindset, what should you do in terms of applying it to debt? Because obviously not all debt is created equal. You have student loan debt versus credit card debt.
Right. Well, so there's even differences within student loan debt, right? So private versus federal. Right now, the federal student loans are on pause, those interest payments. So you could actually earn more just having your cash sit in, 3.5% online savings account. And that's what I would recommend for that until we're required to start to, pay those down again. But credit cards, you might be paying somewhere in the 20% range, and that is more important to pay down than building up cash. And sometimes even private student loans can be higher yielding debt. So that's important to pay off too. But really, it's comparing what can I earn on this money outside, whether that's investments or cash, versus what am I paying in interest? And that's really where the math comes into play. But when we think about discipline and consistency, whether it's paying off debt or whether it's investing in the stock market, I think it's really important to come up with a plan so that if something comes up, you have something to rely on. So to me, that means, okay, let me take $25 every paycheck and put it into the savings account, and then being disciplined with that. Starting off with a number that feels doable. And once you can master that, maybe you can edge up a bit.
Some good takeaways there. Catherine George, WealthStream Advisor, Senior Advisor. Appreciate your time today. Well, coming up on the other side, staying guarded. Recessions tend to begin with small businesses, and many of those see a downturn on the horizon. But how are they and you preparing for it? We're going to look into that and ask if inflation has truly peaked after this short break.
Well, inflation continues to weigh on consumers into 2023. So can you guard against it with an emergency fund? Let's get to Yahoo Finance's personal finance editor, Jana Heron. So Jana, we hear a lot about the need to build an emergency fund when things go wrong. But what exactly should we be accounting for in it? And how much do you need to save up?
Sure, those are great questions. And I think one of the first things is to really define what an emergency is, because sometimes we think something might be an emergency and it's not. So I like to think of these, remember in the pandemic, we had stimulus checks. So an emergency fund is kind of your own personal stimulus check when things go south. You want to tap into this fund when you have an unexpected expense or expenses that, if left unpaid, threaten your personal safety or health, the health or safety of your loved ones who depend on you, so your children, your spouse, or it threatens your ability to make money. So those things are emergencies. So that can be a medical emergency, such as a broken arm or leg, or you need to get your heat fixed in the middle of winter. That definitely is an emergency, or a car repair so you can get to work. Of course, there are other expenses out there that are very important. You want to pay your credit card bills, you want to pay your student loan bills, but oftentimes you can negotiate with your lender for a hardship plan or a payment plan in those instances. So really, personal safety, health, those of your family, and your ability to make money, that's what an emergency fund is.
So, Jana, we've established what the fund is, that you need to set it aside. The question is, how do you go about building it? How much of your monthly income, let's say, should you be setting aside for it?
So the big goal here is you want 3 to 6 months of your essential bills saved up. And 3 months for 2-income households, 6 months if you're a 1-income household. Now, this is a huge amount. And if we've heard the statistics, right, that a third of American households can't cover $400 without borrowing or selling something or just not covering it all. So what I would say is start small. Allocate either your tax refund, your bonus, a little bit of your income, any side gig money, and try to save up for that biggest bill payment that you have that's essential. So for most people, that would be your housing, your rent, or mortgage payment. And so at least you start with that and you have some peace of mind. If something goes wrong, well, at least I have my housing payment covered for next month. And then you can build up to the 1 month, and then 2 months, and then 3 months. And you just don't want to get discouraged or overwhelmed that you need this huge amount of money. Start small. At least you'll have something if things don't go right.
Yeah, start small and build on it. Something to give a lot of Americans peace of mind. Yahoo Finance's personal finance editor, Jana Heron, thanks so much for that. Well, coming up, new year, same Bitcoin. After a chaotic 2022, it's probably more useful than ever to be crypto literate. But are you clear on why the Bitcoin blockchain and the token are very different beasts? We're going to discuss next.
since 2008 have been saying this is not a substitute for fiat money, never can be, and never should be. But at least there are uses to it, and there are potential uses that can come out of the blockchain distributed ledger technology that have nothing to do with cash.
Welcome back to New Year, New You, brought to you by Synchrony Bank Savings. Well, that we just heard from was Yanis Varoufakis, an economist who's been outspoken on the crypto sphere. He was discussing the difference between tokens and the blockchains themselves. And as we start 2023, it's very much new year, same Bitcoin. It's still on the hunt for catalysts to make a meaningful push higher amid noisy calls around its valuation. Cathie Wood remains the standout, calling for $1 million by 2023. Venture capitalist Tim Draper sees $250,000 by the end of the year. And Mark Mobius settling in on $10,000 value by this year. Our next guest says crypto is not recession-proof, but knowledge of crypto is. We're joined by Tyrone Ross, 401 financial principal and founder. Tyrone, so I think a lot of people would agree with you that knowledge is very key after the kind of year we had in 2022. What are you thinking as you go into this year in terms of how investors should be putting money towards the space?
I think it's simple. I think we've learned last year that those that considered themselves investors weren't that. They were traders, they were speculators. So any great investor in any asset class does a lot of research, does a lot of work, asks a lot of questions. And I think that's what we need to step back here and do. And I think the way to do that is exactly through forums like this. Get folks to understand it's about education first. Understanding what the asset is, what it does, your time horizon, what the goal is, and not a second before that should you put $1 into any platform or any crypto asset.
So Tyrone, though, when you hear about some of the valuations, when you hear a Cathie Wood talking about $1 million, other investors talking about $10,000 for Bitcoin, as a retail investor, then what are you supposed to make of this? How do you determine how you should really chart your course from here?
Yeah, that's a great question. I don't make price predictions. God bless those folks to do it. I love Cathie Wood, but as much as I am a crypto hippie, I don't make price predictions. What I think the everyday investor should look at is this. There is a difference between the Bitcoin blockchain, as in the video that you were just showing, and the actual token. The utility is in the Bitcoin blockchain running every day, every 10 minutes, a block is mine. That provides financial infrastructure for folks that has never had it. That is the most important piece here. Similar to like the internet. I can do things on the internet, can't really value it, but the companies and things are built on top of that. If you are a retail investor and say, you know what, the fact that this is reaching so many people and it is a technology that I want to understand and I want to own a small piece of that to kind of be a part of the growth, only then you should look at putting money in, not because someone said that the price is going to 250,000. That has always been a sucker's game.
Yeah, get rich quick, certainly not a big strategy. And you have been very clear that because you believe in the utility of the blockchain, you think that the long-term investment is still a lot of upside there. How much for those who are trying to dip their toes into the space? Are we talking 1%? Are we talking 2%? I mean, what's your advice?
Great question. So I get this a lot. It's hard to say 1%, 2%. I'm probably 100+% just because of who I am and I know it and I live it every day. So it's hard to say that without knowing someone's age, knowing what their savings are, knowing what their time horizon and goals are. It's hard for anyone to come up here and say that. And anyone that you do interview to say that, you should cut them off immediately. But here's what I think folks should do. If you have any interest in any crypto asset whatsoever, here's what you should do. Go on Google, look at the local 3-star, 5-star restaurant and what it costs for 2 people to eat there, drinks, breadsticks and everything included, like you go in the Olive Garden, and put that much into a crypto of your choice and let it sit there like a pet rock for a year and just watch it and see what happens. And then learn from that experience of opening the account, read the terms of service, by the way, the hitting buy on that, and knowing that if you wake up tomorrow and that money is gone, you will still be able to live your life. You tried to play, it didn't work out for you, and you can move on.
So as people are determining whether or not to invest in crypto, I know that you don't advocate it for retirement plans, but as people are trying to figure out perhaps blockchain companies that they could invest in, what criteria do you use and which companies are you eyeing at the moment?
So as far as actual public companies, I think obviously the one that everyone throws around is Coinbase. Coinbase was eviscerated last year in terms of the stock price, but I do think Coinbase has a sustainable business there that I think folks would be able to look at and say, all right, here is a company that has been around. They are public. They have to, provide particular registrations and filings every year. So you can feel comfortable with that. There are some other companies that are kind of teetering on the outside of dealing with the technology. You have Cash App, which is part of Block. You have Facebook as well. But again, you've seen the stock prices of all these companies come in. So I think whether you want to invest in companies that are dealing in crypto or the actual crypto themselves, a lot of caution, high risk tolerance, lots of liquidity, and being able to say, all right, this is what I'm buying. I'm going to buy Coinbase at $40. No matter what happens when it hits $80, I'm out. You have to have that agreement with yourself with any asset class, because if not, then you'll continue to be like the wind. You'll go whichever direction is going, but you should be standard and set in your financial plan what your goals are every day, every year, and only make movements based on that knowledge.
Definitely an exit strategy, certainly important. A big thank you to Tyrone Ross there, 401 financial principal and founder. Thank you so much for joining us this morning. All right, coming up, turning big inflation into big opportunities. After the pain of 2022, could there be a chance to get refinanced in the year to come? We'll ask How to Money author Jean Chatzky. Don't miss it. Turning now to our chart of the day. Americans seeing their personal finances through an increasingly gloomy lens. 36% of Americans seeing their finances stay the same. This according to a Bankrate survey taken in November. Now, there is still optimism, with more Americans seeing things improve rather than turning worse. Well, let's also talk about digging out of debt, because for American families trying to right their financial ship, the PBS television show Opportunity Knocks is trying to provide actionable advice on how to rearrange their financial lives. Well, joining us now is Jean Chatzky, financial expert and a coach on the PBS television program Opportunity Knocks. Good to have you on, Jean. So in dealing with different families and their different financial situations, what are some of the things that you've really learned about how American families are actually doing at the moment?
They're not paying as much attention to the little things as they need to be. I think that was one of the overriding themes. Look, 2022 was a pretty uncontrollable year. We had the highest inflation we'd seen in 40 years. We had interest rates going up. We had the stock market and the bond market both doing poorly at the exact same time, which typically does not happen. There were so many uncontrollable factors. And our goal as coaches on Opportunity Knocks, as well as my goal as a coach in the Finance Fix program that I run at hermoney.com, is to get people back in touch with those things that they can control. That means you need to know what's coming in, what's going out, and where it's going. And we put people through a process of getting in touch with their cash flows, really knowing their data, because only when you know can you make changes. Now, the sunny side of all of this was, of course, the jobs market, and the job market is still good to this day. And so if you're looking to right your financial ship, if you're looking to save a little more, maybe put a little more into your 401k in 2023, you want to be looking at your earnings power.
Yeah, Jean, let's hone in a bit more on that part that you can control. Obviously, your earning power, one, but we've heard a lot from guests today about credit card bills, making sure that's intact, being able to pay that down. What about the rates themselves? Because those rates have gone up. To what extent do you think Americans should be thinking about renegotiating those rates? Is there something they can do?
There absolutely is. And it comes back to one of those other things that you can control, and that's your credit, right? Credit is just a formula. You pay your bills on time, every single time. Your credit score is likely to be in pretty good shape. And that gives you room to negotiate with your lenders, whether we're talking about your credit card companies or whether we're talking about your car loan. A lot of people go in and they buy a car and they don't even think about the interest rate, which right now can be really troublesome. Well, there's a story out just last week that credit unions are charging 3% less than banks on average on car loans. That's real money in your pocket, and refinancing a car loan takes minutes, not months like you're used to with your home. And as far as those credit cards are concerned, particularly for people who still have good credit, there are balance transfer offers out there. You want to take advantage of them and then use that balance transfer period, 12 months, 15 months at a 0% interest rate, to just pay off as much debt as you possibly can.
And as you mentioned, a lot of this comes from really keeping track of where your money's going when you're seeing interest rates change and perhaps not really doing anything about it. What sort of perhaps apps or services do you think people would find most useful if they're trying to really get a hand on their finances?
Look, this is what we do at Her Money with our Finance Fix coaching program. We call it Getting Dirty with Your Data, and we take you by the hand and we help people do it. And we have new courses starting every month. But you can do this with pencil and paper. You can do this with the flows of money that you watch through your online bank account. It sometimes helps to have a coach to keep you accountable. But if you're willing to put in the work and follow the flows of your own money, it is eminently possible with technology to help you.
Jean Chatzky, financial expert and a coach on the PBS television program Opportunity Knocks. Good to get your advice today. Appreciate the time. Well, coming up, don't get stressed. From taxes to inflation and two major spending events in February, we've got your personal finance calendar covered after the break. You don't want to miss it. Now let's get to your new year, new you personal finance calendar for the beginning of 2023. There's a lot of events you'll need to be on the lookout for. So let's kick things off here with getting a sense of the overall health of the economy with this Friday's jobs report. Then on January 12th, we're going to get the first major inflation reading of the year. Then looking ahead, there is a Fed rate decision on February 1st. After that, two big spending events on the horizon in February. You've got the Super Bowl on the 12th, followed closely by Valentine's Day on the 14th. You don't get caught out, depending on how elaborate your Valentine's Day plans are. Finally, one of the two certainties, I should say, in life, and that is, of course, taxes. The key date you need to know for that is April 18th. That is when your individual return from 2022 comes due. And Rochelle, I would argue sort of like the first few events that we pointed to, obviously the health of the labor market, as well as inflation reading, something that you can imagine investors really paying a very close attention to, because that does affect so much of what we've been talking about, which is interest rates. And as we've learned, whether it's credit card bills, your mortgage payments, your car lease, so much of that is going to be tied to what we see the Fed do.
Absolutely. When you think about the domino effect, so these events don't just happen by themselves. They do have an effect on our everyday lives. If you're having to pay a bit more on your car note, that's a bit less that you're going to have to budget for something else. It might be time to perhaps take a look at the multiple subscriptions that all of us have now and probably aren't keeping track on. As Netflix adds $1 or $2 here, or Prime adds, another $20 here. It all definitely adds up. And when you think of things like taxes, that terrifying time when it all really comes home to roost as to how you've really done over the past year. When you're looking at things like your 401k, and you've seen, it's been a very tough year for 401ks, and hoping that we'll see something of a turnaround perhaps in the second half of the year, but really having that mindset of, what do I need to do? Perhaps I need to spend a little bit less on the Super Bowl, maybe not have Valentine's Day, maybe, risk getting in trouble, not spending that much on Valentine's Day, and just do what you have to do at this point.
Yeah, I don't know. I've never gotten the blow your budget for Valentine's Day, but maybe that is just me, that I wouldn't say I'm not a romantic, but there's other days you could spend your money on. You get the sense, though, I should say, in so many of our guests who've talked about setting that emergency fund, that's certainly going to be key. Paying down the credit card, something that I know a lot of Americans think about at the beginning of the year. That's always a goal that's been set. And yet, because of the uncertainties, especially around the economic conditions, you get a feel that might be really key priorities here, at least in the personal finance department, for so many Americans who are saying, well, where is this economy going? 3 months from now, those calls for a recession by, potentially sort of mid-year, end of year, that's got to be weighing on a lot of people.
And you figure that's when we really sort of lay out the fixed versus the discretionary spending that we need to do. A lot of things that really aren't a priority. If you have to prepare for the potential for a recession, you just have to do what you have to do. All right, well, that'll do it for this edition, but we're going to do a final check of the markets quickly before we go, as we take a look as we're heading into the afternoon hour. They're all three major indices in negative territory there. The Dow off more than 200 points, the S&P off more than 35 points, the tech-heavy NASDAQ there down about 1.33%. Well, that will do it for Akiko and myself. We'll be back tomorrow. Thank you for watching. We'll see you then.